Let's talk about understanding what your true return on investment is on an investment and how syndication investing actually works. So there's a number of things that go into that. My name is Mathew Owens. I'm a California licensed CPA, a full-time real estate investor. I've flipped over 1,000 houses. We have over 35 million lent out to flippers in different markets around the country. And we invest both actively and passively into all these different syndication investments out there in different ways, and have a diversified portfolio of our own investments investing in these, and understand that there's some major complexities and a lack of understanding out there of what a syndication is in the first place and how that whole thing works, and what the breakdown of some of these key terms and some of these confusing key terms are when you're investing in different syndications. So first of all, what is an actual syndication? It's primarily a pooling of private investor capital coming together to invest in an opportunity that's run by an outside operator that basically understands and is specializing in that particular asset class. So if one private investor is coming up and is an operator of a deal and finds a big multifamily deal that they're going to raise $10 million for example, then they might do a syndication where different investors come in and invest as little as 25 to 50,000 up to 100,000 or more into that $10 million investment. So they'll raise the money from a pooling of all these different investors, and these investors are now buying shares of an LLC that will then go buy the asset, and the LLC will own the asset and own the property, and everybody will get their splits and their shares of that overall investment. It's usually run by an operator that specializes in that space. So you have specialists when it comes to multifamily, self-storage, debt, mobile home parks, all different asset classes out there that you can invest in. And typically what's happening is they're going to come in and they're going to go operate that asset and do their efficiencies as to it, go value add that asset and put different value add procedures in place and manage it for all of the investors. You have a general partner that does all the work involved, and you have a limited partners that are usually putting in the capital involved in the transaction. Now, there can be different classes of shares and things like that that go into some complexity there, but the general nature is you are investing as an LP investor into a LLC that owns the asset in itself, and you get your pro rata share based on the investment that you put into that deal. Okay. Now, when you're doing this type of strategy, there's some great benefits that go along with it, right? So first of all, you can actually go through and be passive. You don't have to do the work involved, right? You have the general partner that is doing all the work, and they're getting a piece of the deal for doing that, a big piece of the deal for finding the deal, raising the money, putting the deal together. All of that stuff is super important to understand, but you as a passive investor get to come in and just invest your money. Of course, you have a lot of due diligence to do up front on that deal, but you get to go invest your money and be passive. You also, and you don't have to qualify for the financing, you don't have to do the operations work, and you don't have to put all the money up for the deal as well. You can just put up your small piece of that deal, and you can diversify into multiple asset classes, multiple markets around the country, and multiple operators. So you're giving up control of the operations of that deal and relying on someone that's a specialist in that field to then properly diversify into all these different asset classes and really protect yourself and create this massive passive cash flow stream for yourself, so that way you can retire off of that cash flow stream. You can create your active income somewhere else, whether that's a job or you're self-employed or making money in different ways, and you can invest passively over here into these other passive investments. So all these key things to consider when you are the benefits of investing in as an LP investor into these types of deals. Now, there are reporting that typically happens. Most of the general partners report on a quarterly basis to all the investors, the update about the deal, what's going on with the deal as well, what the distributions are typically happen on a quarterly basis. So those things are really key to understand. And then typically there are different splits that happen on the deal. So investors normally, and not all the time, get what's called a preferred return. So investors get paid first as a preferred return on the capital that they put in before there's another split with the general partner involved. So normally that preferred return gets paid first, then the general partner gets a split after that preferred return, so that way there's incentive for performance involved and that there's an alignment of interest. So the general partner is just not giving everybody a bad return and still getting a piece on their side. There's actually a preferred return involved to be able to protect those investors and align the general partners and the investors' interest in that deal. And usually there's what's called a GP, general partner, an LP, limited partner split that occurs after the fact. So these are some key concepts that after the preferred return, there's a general partner and limited partner split on that deal. That could be 60-40, that could be 50-50. There's a number of different, differences there on those back end splits. Okay. So these are some of the main things to understand, right? When you are investing, is understanding what's the preferred return involved. Also, understanding what is the fee structure up front on those deals. You got to do your homework on the operator. Do they have enough experience? You got to do your homework on the deal in itself. You got to do your homework on the market, on the conservative underwriting assumptions and financial model, on the legal paperwork. These are the things you really dial in before you invest in those investments. In addition, there are typically fee structures involved, like an asset management fee, to make sure that operator, the general partner, has enough money to be able to operate that deal and has the right, capital they're getting paid for to manage and operate that deal on top of the actual split. So that asset management fee usually gets paid first, then the preferred return involved, and then the general partner splits on the back end. And there's other fees involved to be aware of as well. Now, there's different requirements and different ideas for what the actual return on investment is. So there's different strategies and metrics that people typically outline, or a general partner typically outlines in that deal. So the first one they typically outline is the cash on cash return on investment, which is absolutely imperative to understand what kind of cash flow are you expecting to make on that particular deal. So, and normally they might be 7, 8, 9, 10% cash on cash return. That doesn't mean in year one you are going to get that cash on cash return. That is typically over the term. Maybe it's a 7-year term or a 10-year term or a 5-year term. That is the average cash on cash return that you'll be getting over the life of that investment as a whole, not including the sales proceeds of that asset down the line once you've improved the value. It's just the cash flow return. And sometimes in the beginning, especially, you're going to have a much lower cash flow return while they do the added value add process and renovate the property and get rents up and do whatever value add strategy that they're implementing on that investment. So you might have an average return of 7, 8, 9, 10%, but then in the beginning only making 3, 6, 7% on the money instead of the higher rate in the first few years, and it ramps up over time to get to that average return. Okay, so that's your first piece, is the cash on cash return, or your average cash flow return on investment. There's also what's called an IRR, or an internal rate of return, which considers not only the potential proceeds when you sell that asset on the back end and get profit for it. Once you've done the value add, or the general partner's done the value add, there are profits involved in that deal upon sale of that asset, right? So typically, and that happens at the end of the investment. And so the IRR takes into consideration the timing of your cash flows. So you might get a smaller amount of cash flow up front. First, you put an initial cash infusion in, and then you get smaller amounts of cash flow as you go, and then a big chunk of cash flow at the end. And the IRR takes into consideration the timing of when those investments happen, and when that return on investment happens to you in the during that entire cycle. So it's going to be a different metric than your cash flow return or your ARR, which is your average rate of return on the actual deal, which is basically just taking out all of your metrics of the exact money you got and saying, what did I average over that 5-year term? That's a different number than what the IRR shows you, which is the internal rate of return considering timing. The average rate of return does not consider timing. The internal rate of return considers timing, and the cash flow rate of return considers your average cash flow over that period of time. You could also have a cash flow IRR as well that you compute when you're investing in these strategies. So I'm sorry for all the complexity there. There's also some additional key terms to understand. One is your cap rate, okay? And there's different ways of computing cap rate, right? Cap rate is typically, when people are understanding cap rate, there's a cap rate at your initial cost of that investment. So you're basically based on the total cost and the total, cost of that deal, all capital infused with debt and equity into that deal. How much money is it producing you on an annual basis based on your cost? That's your cap rate at cost, right? And so that, if you're in it for $100,000 and it's making $10,000 a year in cash flow, then you are making 10% cap rate on your cost. That is different than the cap rate at sale, right? And so the cap rate at sale may be the cap rate that you are selling the property at that other properties are trading at. So normally multifamilies or self-storage or mobile homes or commercial properties in general trade based off of what the other cap rates are going for in that area, versus a single family goes based on comparable sales in that area. This one takes those comparable sales and says, how much are those other investments producing in cash flow every single month based on what they sold for? And that is the cap rate at sale on your investment. It would be the cap rate that you sold for at your sale. So if everything else is trading for a 6 cap at sale, that means it makes them normally 6% on their all-in cost on the sales price. Then you want to look at what is your property going to trade at upon sale, and maybe dial it back and be a little bit more conservative on that deal, and don't assume you're going to hit what everyone else is going to hit. You might have that expectation in your mind, but be a little bit understanding, is the operator and the general partner more conservative in that realm? So understanding some of these key things are absolutely important. We went over IRR, we went over ARR, cap rate, cash flow return on investment. We went over the GP and LP splits involved, what a preferred return is. And then there's the other aspects and understanding how this works on a quarterly basis, on an annual basis, and what to expect as an LP investor, right? So first, you should expect at the very least quarterly reporting, right? And then at tax time, you are going to get a K-1. So you, instead of getting a 1099 for services rendered, you get a K-1 for the investment you made, for your share of the profit and loss on that deal, which could be different than what you actually got in distributions. You might have gotten a 8% or 7% distribution, but the profit and loss that comes through on that investment on your K-1 may be different based on the total profit and loss on the company as a whole and your allocated percentage of that. So you might have some ordinary income flow through, some rental income flow through, some interest income flow through, as well as some massive tax benefits doing what's called a cost segregation study, where they front load a ton of tax benefits in year one. I invested in stuff last year where I got a $600,000 year one tax benefit for investing $600,000. So huge tax benefits, but I obviously still got distributions out. I didn't lose really $600,000. That was a paper loss that flowed through on the K-1 to me, that I went and reported on my personal tax return. So it's always a flow through where your share of the LLC income and loss and distributions comes to you, and you report that on your personal tax return. Now, realize as well that some of these things, as far as timing, may not be what you're used to, right? So you might be used to filing your taxes by April 15th every year. keep in mind the corporate tax returns aren't due until March 15th, and many times they're on extension out until October as well. So, or September, to be able to make sure that, they can get their tax stuff done on time. There's some complexities that go into this. These cost segregation studies take some time. It takes time for the CPAs to compile all this stuff. So don't expect to file your tax returns by April 15th all the time if you are investing in a bunch of these different syndications, because I'm willing to bet many of these operators have a hard time getting everything dialed in and done by March 15th. As far as the tax deadline, they're usually going on extension, and then you're waiting on that K-1 to come to you, could then file your taxes afterwards. So most of the time you'll have to file an extension before you're able to actually come in and do your own taxes. Okay, so these are the things that you should be aware of before you actually invest in syndications. I hope you guys got a ton out of this, and if you guys want more tips and tricks on real estate investing and ways to create financial freedom in your life, go ahead and follow me. I'm on all the different social media platforms. On YouTube, I have my podcast, all the different strategies to be able to help you get that information to create that financial freedom in your life. I hope this helped you guys give some clarity to the syndication space and how things work and some of those key terms that are definitely confusing. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. Three of the key pillars to becoming a successful real estate investor. Number two, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number three, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.